How you doing, guys? Welcome once again. This is Financial Now, uh, YouTube channel for your daily financial news that's going on in the United States and around the world, finance and business. And right now, United States stock market is it's it's in a bear market. It's a bear market right now. Company stocks are falling, prices have fell, and some would say, or what I believe, the market is doing a correction. It's correcting itself. For some time now, the prices were just going up and up. Crypto shot up to about almost 70,000, 70K. Tesla was in the thousands. All these tech stocks, especially, was pretty high. So the market was due for a correction. And since the market is correcting itself, here's some advice for the novice and intermediate investor. And here are some things that they can do to, capitalize on this downturn in the market, in this bear market. So here's an article from Forbes. Um, it's titled "How to Take Advantage of a Stock Market Crash." Okay, so it says there's an old saying on Wall Street: if you don't sell it, you haven't lost it. In other words, the value of your investment doesn't really matter until the day you need to cash out. So don't worry about the ups and downs in the interim. That's cold comfort when your portfolio has lost 20% or 30% of its value in a stock market crash. Just look at the market this month and you'll know what I mean. Or think back to early 2020 when the COVID-19 pandemic began. Market crashes are inevitable and they really hurt. So what should you do when when there's a crash? Make the best of it, and here's how. Number 1, do nothing during a market crash. If you believe in your investing strategy and your current portfolio assets, don't change your plans unless you have a good reason. When you built your portfolio, after all, you might have had a market crash just like this one in mind. People who panic sell during a crisis often regret their choices. Their choice. Take those who jumped ship in spring 2020 when the S&P fell over 30% in a very short period. They were already regretting their moves by summer 2020, when the early COVID market losses had been erased by the lightning fast pandemic rally. And by the end of the year, they had missed out on 65% gains from the bottom of the crash. Number 2, go shopping during a market crash. Market crashes are frequently the result of events like the emergence of COVID-19 or the news that Federal Reserve will change its monetary policy strategy. To make matters worse, rapid market declines can trigger forced trades by aggressive speculators who have borrowed money to buy stocks and are now subject margin calls, further liquidating their stock holdings, leading to a cascade of selling. But here's the thing. A market crash creates opportunities, especially for savvy investors. You may be able to splurge on stocks and funds on stocks and funds you have and funds you had your eyes on at steep discounts, or even you can simply continue buying shares on your regular investing schedule. The best place for novice investors to start is index funds, says New York based certified public accountant CPA Paul Miller. Buy them on a regular pattern consistently, then go to sleep at night, he says. Number 3, dollar cost average. Even on the way down, when the market is dollar cost average, even on the way down. When the market is in turmoil, the safest way to go on a buying spree is to dollar cost average your purchases. That means making purchases of a set dollar value at regular intervals, even when the market looks scary. Dollar cost averaging smooths out smooths out ups and downs of your average purchase price, often lowering it over the long term. Spreading your buys out this way reduces your risk since you won't be investing all of your money when the market is at a particular price point. Hopefully, that helps free you of that what if the stocks get crushed tomorrow fear. If you are investing through a workplace retirement plan, dollar cost averaging happens automatically. If you're investing on your own, whether that's in a taxable investment account or a tax advantage individual retirement account IRA, your brokerage should have a feature for you to automate your contributions. Hunt for dividends during a stock market crash. For the slightly more adventurous, down markets can be a good time to consider letting dividends drive your investment choices. Many companies share their profits with shareholders through a small dividend yield annually, a bit like banks pay interest to saving account holders. While dividends aren't guaranteed and they can change, companies that issue dividends tend to be more mature and their share prices are less volatile. And as long as the dividend is paid out, there's always some gains. This means dividend investing can be a smart move during the market downturns when share prices and returns may otherwise be falling. Number five, ride the sector rotation. A long honored strategy for dealing with market downturns is to move money from one stock market sector to another. During times of high growth, for instance, tech stocks seem to do well. When the economy slows, meanwhile, boring sectors like utility stocks tend to hold up better. So if you strategically move from one to the other, you may avoid large dips in one particular sector. But not everyone is a fan of so called sector rotation. I'm not much into sector rotation. It's another form of timing the market, says Kansas based certified financial planner, CFP, Desmond Henry. You have to time you have to time when you get in and when you get out. I remember when all those stay at home stocks became a big deal. But by the time that trade caught on, it was too late. And even if you time the purchase right, I'm sorry, and even if you time the purchase right going in, when do you get out? You can avoid these challenges, and maintain solid returns by purchasing diversified index funds, which may do well no matter which way a particular sector goes. If you if you own all the market to begin with, you're already poised to benefit from any of its sector growth, which can help prop up other sectors failing in the short term. See our list of the best total stock market index funds for more ideas. Number six, buy bonds during a market crash. Down markets are also a chance for investors to consider a area that novice investors might miss: bond investing. Government bonds are generally considered the safest investment, though they are decidedly unsexy and usually offer meager returns compared to stocks and even other bonds. Still, during the times of uncertainty, Holding some government bonds can make it easier to sleep at night, given their history of flawless repayment. Generally, government bonds must be purchased from a broker, which can get pricey and complicated for many individual investors. Many retirement and investment accounts, however, often bond fund sorry, many retirement and investment accounts, however, offer bond funds that certain many dominate uh, denominations of government bonds. Let's read that again. Many retirement and investment accounts, however, offer bond funds that contain many denominations of government bonds. Don't just assume all bond funds are stocked with safe government bonds, though. Some also contain corporate bonds, which are riskier. Number seven, cut your losses during a crash and save on taxes. Despite our advice above, sometimes cutting your losses is the smartest investing move you can make. Not only does it free up money that you can invest differently, but provided you're investing in a taxable account, it also allows you to claim your losses on your taxes. This investing strategy, called tax loss harvesting, lets you offset income with losses you realize, which may lower your tax bill. It's best to speak with a tax professional before you engage in this strategy to make sure you avoid what's called a wash sale, which happens if you buy an investment that's too similar to the one you sold at a loss. You may also consider having a robo advisor manage your investment for you. Note that the best robo advisors all already have tax loss harvesting features built into them. Last but not least, number 8, if you are retiring soon, tread more carefully. One group of investors who have something to fear from a stock market crash are those facing imminent retirement. It's a huge bummer to start drawing out retirement savings during a bear market. But if you planned out your retirement carefully, you'll likely be able to avoid the harshest uh, effects and anxieties of a downturn. Remember, while you start aggressively when you save for retirement, you're ideally shifting to increasingly conservative, bond based holdings to preserve your savings as you age. You may even employ a bucket strategy that keeps at least a few years of living expenses in cash to fully protect your lifestyle from extreme market dips. However, having the cushion to keep some of your nest egg invested helps you benefit from future market recovery and growth. This can be invaluable for long-term investors of all ages, including those already in retirement. Yep, that's right. You can still be a long-term investor in your golden days. If you're in your mid 60s, you could have 2 or 3 more decades to benefit from investment growth. While that's helpful for all retirees, it's especially important for people who are on less solid financial footing to keep in mind so they can minimize future shortfalls. If you're years or decades from retirement, start planning now how you adjust your asset allocations as you age so you're prepared no matter what the market brings. And if you're closer to retirement than from it, but didn't have money set aside before a market crash, don't panic. Set up a meeting with a financial advisor so you can walk through all of your options. Okay, guys, that was article from Forbes giving you some tips and tricks on what to do during this market downturn, this bear market. and some things that you can take advantage of. I hope this article was helpful. Before you sign off this video, please like, comment, and subscribe. I greatly appreciate it. Thank you.